Welcome back, everybody. Today, we're going deep into high-frequency trading, really focusing on this research paper about how to execute large orders, without crashing the price. That whole problem of price impact.
Oh, yeah, that's the tricky part. Don't want to scare off the market when you're moving those huge volumes. This paper dives into some pretty cool strategies that algorithms use to make those super fast decisions.
And the really amazing part, this research is using some serious math to actually model those strategies,
Yeah.
giving us a glimpse into how those lightning-fast algorithms think.
It's really fascinating stuff.
It is. It's all based on a paper called Optimal Execution Under Incomplete Information.
And this isn't just some theory.
Right.
It's about real-world applications.
Yeah.
What we can learn from this research could actually be useful for all kinds of trading strategies, not just the super high-frequency stuff.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so let's break this down. What's the main issue that these algorithms are tackling?
So imagine you're trying to sell a massive amount of stock, like a gigantic chunk. If you just dump it all at once, you're going to flood the market. Too many sell orders and the price plummets before you can unload everything. That's basically price impact.
Right. Like if you try to sell a super rare stamp collection all at once, suddenly it's not so rare anymore and the price just tanks.
That's it. That's the problem. So these algorithms have to figure out a way to break down those massive orders into smaller pieces,
Right.
less impactful chunks.
Makes sense.
And they got to do it strategically to get the most profit and minimize the risk.
So how do they actually do that? The paper talks about something called Hawk's processes.
Yeah.
What are those? What's so special about them?
Okay. So Hawk's processes, it's a way to model events that kind of influence the chances of other events happening in the future. Think of it like you see a bunch of buy orders for a certain stock all of a sudden. A Hawk's process can help figure out if that's just random noise or if it's actually the start of a real trend.
So instead of just reacting to what's already happened, they're actually trying to anticipate what's going to happen next.
Exactly. They're trying to predict what's coming. By understanding how past trades influence future trades, these algorithms can make much smarter decisions about when to trade and how much to trade.
Wow. So they're kind of predicting this chain reaction of orders.
Pretty much.
That's pretty amazing. But the market's never that predictable, is it? There are always things you just can't know, right?
You're absolutely right. That's where this idea of hidden liquidity comes in. The paper models liquidity. You know how easy it is to buy or sell an asset at any given time? That's liquidity. It models it as a hidden variable. It's kind of like a secret ingredient in the market recipe.
Hidden liquidity. So it's like secret insider information almost.
Well, not exactly. It's more like it highlights the fact that nobody can really know for sure how deep the market truly is at any given moment.
Right.
These algorithms have to try to estimate this hidden state based on what they can actually see, which is the flow of orders coming in.
So they're dealing with incomplete information, trying to solve this super complex puzzle in real time. What's their secret weapon? How do they even begin to approach that?
They use a really cool technique called stochastic filtering.
Okay.
Basically, it lets them constantly update their estimate of the hidden liquidity based on all that incoming order flow data. It's
Wow.
kind of like adjusting a recipe while you're cooking. You taste it, you add a pinch of this or that. You just adjust as you go based on what you're sensing.
So they're making these educated guesses
Yeah.
and constantly refining them as new information pops up. It's pretty clever. But how does all of this actually translate into an actual trading strategy?
So the researchers frame this as an impulse control problem. It's about figuring out like the perfect times and sizes for those smaller trades to minimize the impact on the price overall.
So it's not just about breaking up the big order, it's about the timing and the size of those smaller pieces as well.
Precisely. And this is where it gets interesting. They include what's called a concave price impact function. Essentially, it means that the larger the order, the bigger the impact it has on the price. And it's disproportionate. A really large order has a way bigger impact than you'd expect just from its size.
Oh, I see. So if you try to sell a huge chunk all at once, you're going to freak out the market way more than if you sell little bits at a time.
Exactly. That's the key. So these algorithms have to be really careful about the size of their trades, especially when they're dealing with a lot of inventory.
This is giving me a whole new perspective on how complex these high-frequency trading algorithms really are. It's not just about speed, it's about intelligence and being able to adapt.
You hit the nail on the head. Let's get to the really exciting part, the results. What did the researchers discover when they put these strategies to the test?
What kind of things did the researchers learn?
One of the most interesting findings is that the best strategy actually changes based on the estimated liquidity. Remember that hidden liquidity thing we were talking about? So that plays a really big role in how the algorithms act.
Okay, I'm following you. So how does the algorithm actually use that information? Like, walk me through it.
Okay, so let's say the algorithm thinks that liquidity is high. That means there are a lot of buyers and sellers in the market. So in that situation, it can be a bit more aggressive. It can sell bigger chunks of stock without making the price crash.
Makes sense. If you know there are a lot of people who want to buy you, can be a bit bolder when you're selling.
Exactly. But imagine the algorithm senses that liquidity is drying up. Maybe the market is getting uncertain or everybody's reacting to some big news story all of a sudden.
If I was the algorithm, I'd start to feel a bit uneasy. Like, better to be more careful, right?
You got it. The best strategy in that case becomes way more conservative. So the algorithm starts trading smaller amounts so it doesn't scare the market and cause an even bigger drop in liquidity.
So it's all about adapting to what's going on in the market at that exact moment. These algorithms are like chameleons, constantly changing their approach depending on the environment.
That's a great way to put it. And remember, they're doing this super fast. We're talking milliseconds.
Yeah, my brain is struggling to even keep up just thinking about it. What else did the researchers find? What did those fancy visualizations show?
Well, another interesting thing is how the amount of stock the algorithm still has to sell actually affects how urgently it tries to sell. So as you might expect, the more stock it has to get rid of, the more pressure there is to unload it quickly.
That just makes sense. The bigger the job, the faster you want to finish it right.
Right. But here's where it gets more complex. The visualizations show that as the algorithm starts to sell more of its stock and has less remaining, it actually gets more patient. It starts to wait for just the right price to sell.
So it's not just about getting rid of the stock as quickly as possible. It's about getting the best possible price.
Exactly. It's trying to balance everything. It needs to sell fast enough to make sure it doesn't end up holding a lot of stock if the market suddenly crashes, but it also needs to wait for a good price so it's not selling for too little.
Man, there is so much that goes into these strategies. It's incredible. I'm starting to think I need to step up my own trading game.
Well, that's what's so cool about this research. It shows us how these high-frequency trading algorithms actually work, but it also teaches us lessons that any trader can use.
Absolutely. Speaking of learning, I'm curious about those concave price impact functions we talked about earlier. How did that actually affect the results?
That's a really good question, and it actually led to some pretty surprising results.
Okay, I'm all ears.
Remember that a concave price impact function means that bigger orders have a much bigger effect on the price than you might expect. So you'd think the algorithms would always want to trade in small amounts to avoid that, right?
Yeah, that's what I would have thought. Smaller trades, smaller impact.
But what's interesting is that when the price impact is high, meaning the market is super sensitive to the size of orders, the algorithms actually make their trades even smaller.
Wait, so they're actually trading less when the market is more likely to react strongly?
Precisely. It's like they're thinking, okay, the market is a bit jumpy right now. Let's not make any sudden moves. They're adjusting to how the market is behaving in real time. It's really impressive.
This is all so fascinating. It really shows how complex and adaptable these high-frequency trading algorithms are.
Exactly. And it really highlights how important it is to understand price impact and liquidity when you're putting together a trading strategy. It doesn't matter if you're a high-frequency trader or not.
Absolutely. So what's the main takeaway here? What have we really learned from looking at all of these results?
I think the main point is that high-frequency trading is about a lot more than just being fast. These algorithms are working in an environment that's constantly changing. And to be successful, they have to keep adapting to changes in liquidity and carefully manage price impact.
It's like they're playing a game of chess, but the stakes are super high and the game is moving at warp speed.
Exactly. And while we might not all be high-frequency traders, understanding these ideas can give us a better understanding of how markets work and how we can become better traders ourselves.
This deep dive has been truly enlightening. It's like I'm seeing the market in a whole new light.
Yeah, so we've talked about the challenges, we've explored how they're modeling all of this, and we've seen these strategies in action. So what's the big takeaway? Why does all of this matter?
That's the real question, isn't it? Like, this isn't just some theoretical thing. This research actually has real implications for how we understand markets and trading, even for those of us who aren't, operating at the speed of light.
Right. Okay, so give me the big picture. How could these insights be applied to longer-term trading strategies?
That's what's really cool about all of this. The research was about high-frequency trading, but those core ideas could actually apply to all sorts of trading strategies.
Exactly. Think about it. Those key ideas we talked about.
Hmm.
Understanding price impact, adapting to those liquidity changes, strategically timing and sizing your trades. That's all crucial for successful trading no matter what the time frame is.
So it's not just about how fast you can trade, but about how smart you trade.
Yeah, you got it. It's about recognizing that markets are complex and dynamic and that liquidity is super important. This research gives us a way to understand how all of that works.
This research has given me a lot to think about, for sure. It seems like the main takeaway is that we need to be more aware of how our actions as traders, actually impact the market.
Absolutely. We can't just follow trends or go with our gut feeling. We need to be more like those algorithms, analyzing the data, updating our view of market conditions, and changing our strategies based on what we see.
That sounds like a lot of work. Most of us don't have, the fancy computers or the math skills to do what those algorithms are doing.
That's true, but we can still learn from how they approach things. It's about thinking more in terms of data and being able to adapt. It's about asking yourself questions like, okay, how will my order affect the market? Or is there enough liquidity for this trade? And what's my plan if things go wrong?
You've definitely given us a lot to consider. I bet our listeners will have plenty to discuss after this.
I hope so. The more we can learn about these forces that drive market behavior, the better prepared we'll be to navigate them. And hey, who knows, maybe this deep dive will inspire some of you to explore those mathematical models a bit more.
Well, a trader can dream right. A huge thank you to all of our listeners for joining us on this deep dive. Until next time, happy trading, everyone.